The doors are locked, but the line keeps growing. It is early morning, and people are holding bank cards that no longer work, staring at a notice taped to glass explaining that withdrawals are temporarily suspended. Inside the building, nothing is on fire, no alarms are ringing, and no one is running, which makes the silence more unsettling. Money still exists on paper, yet access has become conditional, and that distinction is where collapses actually begin. Scenes like this appear scattered across history, separated by decades and geography, yet bound by the same mechanical failure. Argentina in 2001, Cyprus in 2013, Greece in 2015, Lebanon more recently, all recorded moments when the financial system did not disappear, but stopped functioning for its users. What followed was not immediate poverty, but a slow reordering of what counted as real wealth. The present day does not announce collapse with locked doors and handwritten signs. Instead, it shows rising debt loads, increasingly complex financial products, payment systems layered on top of promises, and a quiet assumption that liquidity will always be there when needed. That assumption only holds in stable systems. This analysis examines what has consistently survived when that stability breaks, and what reliably fails despite appearing safe right up until the moment it is not. The outcome is not a checklist or a recommendation. It is a pattern, observed repeatedly across collapses, currency resets, and institutional failures. To understand it, a framework is needed that goes beyond asset names and focuses on function. Think of collapse not as a single event, but as a sequence. First comes confidence erosion, then access restriction, followed by repricing, and finally, institutional rewriting. Assets do not survive or die at random during this sequence. They survive based on where they sit relative to control, counterparty dependence, and necessity. This distinction matters. In every collapse, certain forms of value remain usable because they exist outside the failing layer, while others vanish because they are trapped inside it. The difference is structural, not ideological. Consider land, but not as an investment line item. Across feudal collapses, revolutions, hyperinflations, and regime changes, land that could be used productively retained value, even when currencies failed. In Weimar Germany, farmland fed families while paper marks became fuel for stoves. The mechanism was not appreciation, but continuity of use. Land tied to food, shelter, or production exists at a lower layer of the system than money itself. Modern parallels appear in failed states where formal property rights blur, yet physical control and use still matter. The risk is obvious, as land can be seized, taxed, or destroyed, but it rarely goes to zero in functional terms. Gold occupies a different layer, one that history returns to repeatedly, despite attempts to replace it. During the fall of the Roman Empire, debasement reduced silver content in coins until trust collapsed, and gold became a parallel unit of account. Gold survives not because it produces, but because it settles. It carries no counterparty risk, no issuer, and no dependency on payment systems. That said, gold fails as a growth asset and often underperforms during long periods of stability. Its survival function activates only when institutional trust breaks. Cash, when it is physical and locally accepted, also survives longer than expected. During bank freezes, people do not stop using money immediately. They revert to what circulates without permission, which historically has been notes and coins already in hand. In Argentina's Corralito, physical dollars traded at premiums because they bypassed frozen accounts. The limitation is duration, as inflation eventually erodes purchasing power. Cash survives the access phase, but not the repricing phase. Food and basic commodities form another category that history treats differently. During sieges, wars, and currency collapses, calories and energy become direct units of value. In post-Soviet transitions, goods like cooking oil, cigarettes, and sugar circulated as informal money. The mechanism is necessity. However, storage, spoilage, and security impose practical limits, making these assets situational rather than permanent. The final survivor category is skills and social capital, though not in the abstract sense. In collapsed systems, people who can fix, build, treat, or produce retain exchange power regardless of currency regime. After the fall of the Soviet Union, engineers and doctors traded services for food and shelter during cash shortages. This survival depends on local demand and physical presence. Skills tied to global platforms or credentialed institutions fail alongside those institutions. At this midpoint, the pattern should be visible. This channel's focus is financial forensics, studying past system failures to understand what survives. The survivors all share one trait: they function with minimal reliance on centralized permission. Now the contrast becomes unavoidable. Certain assets fail not occasionally, but almost universally, despite appearing sophisticated and safe. Bank deposits sit at the center of this failure category. They are promises layered on promises, accessible only through functioning institutions. When confidence erodes, access is restricted before insolvency is admitted. By the time depositors understand the risk, conversion has already occurred. Equities tied to domestic financial systems also suffer recurring wipeouts. During revolutions, wars, and currency resets, shareholder rights are rewritten or ignored. The Russian Revolution, Chinese nationalizations, and countless emerging market crises reduced equity claims to historical footnotes. Even when companies continue operating, ownership structures rarely survive intact. The third category that reliably dies is long-duration debt. Bonds depend entirely on the issuer's continuity and willingness to honor terms. Inflation, restructuring, or regime change eliminates that certainty. History does not record this as a warning, because defaults are often reframed as adjustments. At the system level, these failures share a mechanism. They exist entirely within the collapsing layer and cannot exit when pressure rises. Survivors either sit below that layer or operate parallel to it. Applying this framework to the present does not require prediction. Debt levels are higher, financial instruments more abstract, and systems more interconnected. Access remains the first variable to watch, not price. Payment systems, custody chains, and regulatory reach define what can be used during stress. Assets that appear liquid today may become immobile tomorrow. Understanding this shifts behavior from chasing returns to assessing position within the system. It reframes wealth as usability under constraint, not valuation under optimism. The synthesis is not a directive, it is a classification. Assets that survive do so because they retain function when permission is withdrawn. Those that die depend on continuity that history shows is fragile. Returning to the locked bank doors, the people in line are not thinking about portfolios. They are thinking about dinner, rent, and tomorrow. Collapse does not eliminate value. It reveals which forms of value were real all along.